Hello, folks. Good to be with you. Nice to see you all. Glad you're here. And this is going to be one of a series of shows. This is Mike Neumeier, and this is the Mike Neumeier Game Plan for Retirement show. The phone number here, 410-902-0464. Call with your questions. We try to focus on the kinds of subjects that people are interested in. If you call us for questions, we'll try to answer them for you, and if it makes sense, we'll include the topic, in a future show. So many times I've been asked through the years for definitions on some of the terms that people listen to on the radio or on television, on financial shows, and so on. So what I'm doing is I'm taking the universal answers, the specific answers to the terminology that we hear in the industry and that we hear from estate attorneys and so forth, and financial advisors. So I'm going to give you some answers today, and I'll give you answers on other terminology in the future. So first one, this is one that most people have never heard of. This is, let's say you wanted to retire early. You wanted to retire in your 40s or whatever. And you have to be 59 and a half to take money out of 401k as an example, or an IRA as an example, and not having to pay a penalty. The penalties right now are 10% plus the taxes. So if you take money out of a 401k in your 40s or 50s, generally speaking, a few exceptions, but generally speaking, you're going to pay a 10% penalty, plus you're going to pay the taxes. Okay, so how do we avoid that? There is a section in the IRS code called a 72T. And the 72T provides you an opportunity to take regular income and start it, at any particular age. And this is what a lot of sports figures do because they retire early. But you can do it. Anybody can do it. And what it means is that you have to take substantially equal payments, which in reality means the same amount of money on a regular basis, monthly or whenever. And we file a 72T. You file a 72. Your accountant files a 72. We prepare the work. If you want to do that, we can help you do that. So 72T, that's the first one I want to tell you about. Lots of definitions we're not going to cover today. We'll cover more in future shows. Second term that you'll hear infrequently, even from estate attorneys, is what's called a bypass trust. A bypass trust is a legal agreement established by married couples that allows each spouse to take advantage of the unified tax credit. A bypass trust can be part of a will or a living trust. So that's something you might want to write down before you would meet with an estate attorney and ask them, or him or her, what that might have to do in your situation. So bypass trust, something to bring up with them. All right. Charitable remainder trust is a trust that is irrevocable. You cannot revoke a charitable remainder trust, and allows the grantor. You're the grantor. Whoever is doing this is a grantor. So allows the grantor to take continuing income, and then after you pass, whatever is left goes to a charity. So that's a charitable remainder trust. And let's say you were going to leave money to various heirs and beneficiaries, but you wanted to isolate this amount of money to end up, or this particular, source, the balance left to end up in a charity. That would be an appropriate way of doing it. And now the next one I want to mention is collateralized mortgage obligations. These are CMOs. And this is a bond that's investable grade bond, okay? So it's rated, from AAA down to whatever, down to the bottom. But it's investable grade. So what this is made up of mortgages. It's a bond made up of mortgages, and each payment to the bondholder, you would be the bondholder if you invested in this, represents both part of the principal and part of the interest. Generally speaking, considered a pretty good investment for if it's suitable for you. But that is what a collateralized mortgage obligation is. And we've seen these before, and they've done well at certain times. but it's something that you can consider when you're looking at your portfolio of investments. Okay, next term I want to mention to you is called vesting. And you've heard this, and many of you know what vesting means. If you have money in a plan at work and you decide to leave, how much of the money you have in the plan is going to be available to you to roll over to an IRA. Okay, that is, and it has a lot to do with the employer's contributions to the plan. So how many years do you have to be in the plan for you to be totally vested? And so that's something you want to know if you're considering, leaving a company. You want to know when you look at your 401k, how much of the money will not pass to you based on how much they have contributed to it. So we're always trying to meet the match. That is to say, the level of money that we're contributing so that we get the match to that in terms of the promises by the company to contribute to your plan. But the other side is if you leave the company before retirement age, then, it may not all be vested. So you want to know what the story is. By talking to HR, if you're leaving the company early, they can show you, what is vested. Another term that many people know and some don't is one of the kinds of permanent life insurance, which is whole life insurance. Now, whole life insurance is a permanent insurance for an individual. The main thing that makes it different is that it builds cash value. So from that point of view, it can be an investment, for retirement. And money comes out technically considered a loan you never repay, but because it is a loan, you don't pay taxes on it. Even though it is grown in there, since it's considered a loan, it's not taxable. So that is something to consider for long-term investing for retirement, something you should understand. There are other forms that follow the same rules. Universal life is a permanent insurance. It follows the same rule. Index universal life is one that's based on the indexes, like the S&P 500. So those are variations. If you're interested in looking at those things, we do those, and we're more than happy to explain them to you. So don't hesitate, to give us a call. Come on in, and we'll help you with that consideration. Okay. Now, that finishes what I want to show you on this particular page. And the next term I want to talk about is a testamentary trust. Now, there's a lot of different kinds of trusts, and we're going to talk about a few. A testamentary trust is a trust often created by a will. So it comes out after you're passed, then it comes into existence. And typically because of a will that takes effect at the death of the person setting up the trust. So it isn't alive, it doesn't exist really until you pass. Applicable to some situations, state attorneys can explain, the difference between that and a living trust. A living trust is a way of passing money without taxes, but it is a trust, and you can use it while you're alive. You can put your assets in it, and so that is another kind of a trust that you can discuss, with your estate attorney. And also with your accountant. That's worth discussing with your accountant. Okay. I want to talk about the next term, which is the Consumer Price Index. Now, we hear about the CPI. You're going to hear it on television day in and day out if you're watching a financial show. And so what is the Consumer Price Index, the CPI? It's a measure of price changes in consumer goods. So things that are sold retail, that the average person buys, are in the CPI, in that index, also known as the cost of living index. So common CPI components are food, housing, and transportation. May exclude some things, but those are typical components inside the CPI. CPI is very important because you can tell how much inflation you're experiencing by looking at the CPI. And the producer's price index, which is a PPI, is telling you what it's costing the producers that make those goods. Well, the PPI, of course, is basically going to trigger the CPI. So, they're very much related. So when you follow those indexes and you hear those indexes, believe me, they're going to have effect on you pretty soon. And now I want to talk about a couple of things that relate to estate planning and estate and managing your own money and having some help from somebody else if you're unable to act. And the most important of which is the durable power of attorney. Now, there's a number of powers of attorney that relate to specific things. You know, you have a power of attorney that relates to a particular investment, or you have a power of attorney that relates to a certain property, and so forth. But and it ends under certain conditions. A durable power of attorney lasts up to your lifetime, and if you want it to, and you're allowing somebody to act in your behalf if you're unable to act. So, you know, you could be sick, you could be in a coma, you could be unable to act on your own, you're incapacitated in some manner, and a durable power of attorney means that you can act in the place of that individual. Very powerful, very sometimes misunderstood, and not always recognized. You could go to a bank and here's my power of attorney and I want to do this for my friend and so forth and so on. Then they should act on it and so forth. And sometimes they don't know what they're doing. So keep that in mind, that not everybody understands a durable power of attorney. And durable means it lasts until you actually end it and so forth. It's up to you. So it's not defined by a particular asset or the asset's gone or whatever. This is a durable power of attorney. It has a duration for your lifetime, but it could be cut off. You could change it. It can be rescinded by you. Okay, and then face value. Face value is indicated on a certificate of security. The face value. All right, it's a debt instrument, so it could be a bond, and it's the amount of money you're going to get back at the end. When that period of time has passed, you're going to get this money back, that is the way it works. So that's what face value means. All right, a CD. You put money into a CD. At the end, you're going to get that money back. In that case, you're going to get it with interest, unless you've taken the interest along the way, and you can do that. You can take the interest, and you can have the interest transferred to another account. All right. And then a gross estate, sometimes misunderstood. The total value of a person's estate before deductions are made for debts, taxes, funeral expenses, attorney's fees, or administration costs. Now, it doesn't mean that some of those have to be paid through the estate. Okay? They could be paid separately, in which you would not be deducting them from the gross estate to come to the net estate. But this is what gross estate means. It's before deducting whatever costs will be deducted from it. So that's the gross estate, and that's that. Interest rate risk. Now here's an interesting proposition. Let us say you put money in a money market rate, in a money market, and it's paying X percentage. Let's say today, in fact, in today's markets, you can get over 4% in some money markets. Okay, but you put it in, but that number can change with interest rates in general. So that they could go in at 4, it could go to 5, it could go to 3. It isn't fixed. It's not fixed. It's not like a CD where you go into it and it says, okay, I'm going to give you 5, I'm going to give you 4, whatever it is. You're guaranteed that rate. But in a money market, it can fluctuate. Okay, because it's tied to the other interest rates, the Fed rates, and so forth and so on that are established outside of that particular instrument. Okay, so that means interest rate rates. Let's say hypothetically that you started out with 5 and you ended up with 3. There is a risk that you are not going to get the same percentage that you started out with. Now that could be advantageous because it could go up, but we don't know. So there is a risk to interest rate. Is it going to change on you in a negative way? Next term, intestate. Intestate. That means you died without a will, a legal will. You died without a legal will. The distribution of assets is overseen by a probate court, and assets are distributed according to state law. And in Maryland, we call that the orphans court. You're going to go through probate on the your assets, and that's going to be determined by law who gets what. Now, there are, besides a will, there are some way to avoid some of that process. Anything that's marked transfer on death, anything with a beneficiary does not go through probate. Our products that we sell to people all the time have beneficiaries, so those don't go through probate. They pass immediately upon your death. They pass immediately to that beneficiary, so they don't go through probate. That's a very important distinction. Okay, so that is that, and let me see what else I have for you. Just a few more. We'll cover a lot more on other shows. All right, IRA conversion. Not understood by some folks. The option in an IRA conversion is the option of changing a regular IRA to a Roth IRA. So you can convert them. The timing of the conversion is very important. Your accountant should guide you on when it is a good time to convert a regular IRA to a Roth. And why is that? Because if you take enough money out and convert it, you have to pay a tax on that money coming out of the IRA. And if you do that, it could raise your marginal rate and your tax. That's bring it up to the next level. So you want to talk that over, with your accountant. Irrevocable trust. Now, irrevocable trust it means that the terms can't be changed in that trust. This type of trust may offer estate tax saving benefits. That's another thing you talk over with your attorney, with your estate attorney, but also with your accountant to see whether that fits and makes some sense. Level term insurance. Most people understand this, I think. When you buy life insurance, term insurance, the most desirable term insurance that you can buy is not going to charge you more premium each year. Okay, they're not gonna charge you more money for that insurance. Okay, that's level term. That is the most desirable. When you're getting a quote on insurance from us, we're going to tell you what the level term is if it's term insurance. We're not going to encourage you to buy renewable life as an example, because that means the rate can go up. So you don't want to worry about that. You want to know that this is what's going to cost me, and that's level term. Liquidity, most people understand. It's the ability to take assets and quickly convert them into cash within a very short period of time. That's liquidity. It doesn't mean it all is in cash, but typically it means that you can convert it very quickly to cash. So cash and cash-like kinds of products, that makes up liquidity. What's liquid money today or tomorrow or the next day or in a very short period of time? A living trust. A living trust is a trust that's developed by a person during his or her lifetime. Typically, it's used to maintain control over assets during life and control of the disposition of them at death. A living trust avoids the probate process and may provide for immediate distribution of assets. So that's a living trust. And you want to be aware of that. The tax consequences could vary, but that's what a living trust is. It gives you control, of assets and so forth while you're alive, and creates the beneficiaries of those that will benefit afterwards after you're gone. A living will, very important. Instructions are given to the medical staff, telling them whether you want your life sustained if it becomes improbable that you would regain any quality of life. So typical terminology in there is no heroic measures, which people often include, in a living will. So that's that. And what else do I have? That's all I have on that page. And then finally, I mentioned probate already, because I said that if you die intestate, that everything goes through probate again, which is called orphans court here in Maryland. And risk tolerance, very important in determining the suitability and the proper kinds of investments and so forth that are good for you, that is in your best interest. And that's the term we use today, is in the best interest of the client. So that is basically what we have to establish. We have to establish that, based on your risk tolerance, how willing are you and able are you to sustain how much risk? And that's something that we counsel people on, because some folks may think that they want to take more risk than it's obvious that they should. So I try to guide folks and tell folks my opinion. Still their decision, but my opinion. In some instances, you have to turn people down on certain kinds of investments because it's obvious that it's not suitable for them, based on their health, based on other circumstances. What is a rollover? What's a rollover? Now, a lot of folks think they really understand that, and I'm just going to go through it the way it's written. The investment of assets received as a lump sum distribution from a qualified plan. What's a qualified plan? One that's qualified by the IRS, IRAs and 401ks. Those are the kinds of things that are typically a qualified plan can be converted and has to be converted, into an IRA. All right. So that's what a qualified plan is, and it's a qualified tax deferment retirement plan. Reinvestment may be the entire amount or any portion, and the transaction has to be completed within 60 days. Now, according to the Secure Act, basically you can only do this kind of movement from an IRA or 401k and so forth once a year. So if you come to us, we have to guide you on this, that you can only do one of those once a year. And that means that you're receiving the money, you're putting it in a bank account, into a checking account, and you're writing a check to the new investment company. You can only do that once a year. Now, an institution, so from an employer or whatever, to a bank or to an investment company or to an insurance company, is institution. You can do as many of those as you want. But you can only take the money and complete the process within 60 days once a year. And we will tell you this if you come to visit with us, of course. We'll make sure you do it the right way. Survivorship life insurance. A life insurance policy that covers the lives of two or more individuals, typically a couple, and pays a benefit only at the death of the last insured. That's sometimes referred to as second to die insurance. And that's that. Now, I want to correct one thing I said earlier. I think I might have misspoken when I said that trust means that it's not taxable. It may well be taxable. That's the situation. Okay? Come back for my next show, and I'm going to try to cover more of these terms. Call me with questions, 410-902-0464. Mike Neumeier, good to be with you.